Hi, my name is Andy Day. I'm the founder and CEO of Capital A, and welcome to M&A Q&A. Today we have a real treat for you. It's Chad at Lion-Cachet, who's the CEO of Clico Capital. So I've known Chad for a couple of years, maybe even 3 or 4 actually. We worked together on a deal which didn't quite make it to the finish line, unfortunately. But Chad has had a very distinguished career in agencies and M&A. So I'll just take you through a potted history. Chad's worked in London and New York, leading the sports, media and entertainment division of global professional services firm Marsh & McLennan. In 2003, Chad joined Sportsworld, which is a corporate hospitality provider, but by 2004, Chad led an MBO of Sportsworld where he acquired the full share of capital. Followed by further acquisitions, and after years of successful growth, Chad exited that business, selling the company to TUI Travel PLC. Chad stayed on as chief exec until 2012, when the company posted a record turnover in excess of 30 million. He was then promoted to chief executive of the Events International Group, which is TUI's event division, eventually leaving in December 2016 to establish an integrated events services group by leading a management buy-in of the agency Smile Creative with Rockpool private equity firm. So Chad served 2 years as chairman at Smile before leading another MBI of hospitality agency Engage, where he's currently building the business for growth and an eventual exit. So having done 3 MBOs, Chad is super experienced in finding business opportunities and investment partners and getting those deals done. And there's plenty of opportunity, I think, for us to learn from his story. So Chad, how are you doing?
Andy, I'm doing very well, thank you. Appreciate the opportunity to join you today.
Yeah, welcome to M&A Q&A. So we're going to kick off with a quick background check, which we do every week for our guests. So we just want you to tell us a little bit about your background, your story of how you got into events, the events agency world, and what your passions were before getting the business bug and ending up leading all these hugely successful businesses. So you tell us a little bit about your background.
Yeah, with pleasure. I'd come over to study at Oxford and did my master's in management studies there, having come out of South Africa. And having done that, just spent a little bit of time in the UK and joined what was the predecessor of Marsh & McLennan, was transferred to New York. So it was really then that I started to get into a little bit more of a management consulting and risk finance. And for a good 10 years between New York and London, spent a lot of time both on the finance side, but also beginning to get under the skin of the sports, media, technology, events industry. So from an advisory point of view, started my interest, when then ultimately I wanted to move more into the front end of sport, as it was, and I was introduced to Sportsworld, which was then the acquisition that we did in end of 2004.
Right. So that's quite surprising, actually. So you came from, I was expecting you to have a real passion about sports, actually, and that's where you got in. So actually you came from the advisory side.
Yes, the nature of the work we were doing was advisory, whether it be placement of insurances, whether it be risk advisory work for various governing bodies, sports governing bodies. So it was there where I got exposed more and more to the kind of opportunities that those industries were throwing up. And if you remember, back kind of 2000, it was a fairly unsophisticated environment, and therefore, you know, arguably loads of opportunity. So we then established at Marsh & McLennan the Marsh Sports Group, and we built that on a pan-European and then ultimately global basis from about 2000 to 2003. And that too grew to a good 30 million euros at its peak as well. So a great opportunity with some great people, and then wanted to move more into the front end of sport.
So you then joined Sportsworld in 2003 as managing director. Can you tell us a little bit about that business when you first arrived and who owned it, and give us a bit of background?
Yeah, just a fantastic pedigree. It was based in Oxfordshire. I wanted to get back to Oxford, so it kind of made sense, which is where we moved to. And a diversified agency, very specifically sports, hospitality and travel. and that was its area of focus. Had some great contracts, but its two founders were at this stage in their late 50s and wanted to move on, and I saw there was an opportunity then to sort of lead that management buyout of that business, which, as I said, we completed in the December 2004.
Right. So you actually went in. What was that process like? Did you apply for a job, or did you see that there was an opportunity before you even went into the business?
We saw there was an opportunity beforehand, and then kind of moved down and got into the business, so that effectively it was a buyout from the inside. And obviously, as you well know, you can do the buyout from the inside, or by way of kind of management buy-in, you can come in from the outside, join an existing management team, and buy the business out that way. So in each of the various examples that I've had, I've done it both ways, if you will, with supporting management teams in all the cases.
Right. And so you went into that business with sort of partners already.
There is existing management, the existing management there.
Okay.
And then what we did is we very quickly made a couple of smaller acquisitions, bringing in what we felt we needed by way of additional management resource.
Right.
So they came in, had an equity stake in the business, and were then able to support the growth of the business as part of the business, having already acquired their businesses into the holding group, if you will.
Right. I was going to ask you about that in the next question, actually. So, so those deals that you did, those acquisitions that you made, they were fully mindful of the sort of, I suppose, experience gaps that you had in the business, and also that you knew that you were building for an exit at the future point.
Yeah, listen, there's no doubt, and I will absolutely go on record, there are plenty of experience gaps in my career, and learning on the job or through experience by doing deals is not a bad way to go, because you do bump your head. So there's no question that I wouldn't hold myself out in any way, shape, or form of being an expert in any kind of MBO field. Having said that, one does build some of that credibility through actually doing the deals and getting them away, because the reality is getting any transaction away is an effort, and therefore, having bumped my head a number of times on the deals, both within Sportsworld and outside, and trying to acquire Sportsworld in the first place, it's all of a learning curve, and it has been for me since then, to be honest.
So were some of those acquisitions that you made, or some of those people that you brought in from the outside after you'd made the acquisition of Sportsworld, were they because they had specific experience in exiting businesses themselves? Or
no, there wasn't so much corporate experience they had, but they had the experience required for the growth of that business that we were working on.
Right.
So the acquisitions were complementary to support our ultimate aim of being able to grow the EBITDA, therefore build higher value for the business, and ultimately have an exit. And if I'm honest, at that stage, it was very blue sky, wouldn't that be great one day, kind of thinking, as opposed to starting off with a very prescribed route or blueprint through to an exit. But as you're running the business, getting a handle on the business, focusing on kind of the immediate short-term issues and potentially the longer-term value creation, you then work out that actually, if you did do an acquisition, you could almost double your EBITDA in an afternoon compared to organically growing it as we were doing over a number of years. So the combination is what ultimately I then started to look for.
Right. So yeah, I often say that, actually, doubling your EBITDA overnight. But I mean, those acquisitions, did they take a long time, or
some did some were quite soon after. Once I'd done the deal, I already had one of them in mind. And these weren't massive acquisitions. In many cases, they were one or two people that were plugging a specific gap by way of resource or service, or were bringing a new product to us or service line. And in that way, we slowly kept the core business, but were able to complement it with sort of bolt-ons, add-ons, in order to position ourselves in such a way that we had a much broader service offering and product offering to the market.
Right. Okay. I think that's good information for everybody here as well, because it's you know, the sort of glamorous end of acquisitions is huge, multi-million pound deals, but it's good to know you were making some small ones as well and just bolting them into the business.
Yes, and I think that's a very, very valued route to growth. You know, the buy and build strategy where you buy your core, what I'd regard as your platform business, and then begin to add strategically onto that to either build out where you've got some deficiencies or adding further strength to where you're particularly differentiated. I think all of that is a very legitimate way of building your EBITDA. Look, the focus for us would be EBITDA growth, and therefore, if you can continue to add EBITDA growth on an annual basis, you are moving towards your higher valuations because you're a bigger business, and bigger businesses demand a higher valuation.
Mm-hmm. Okay, that's brilliant. Okay, so ultimately, then you exited that business. You sold to TUI, so that was the company that owned Thomas Cook. It's the holiday company.
Thomas Cook Thompsons. So they
sorry. Okay, yeah.
They would own Thompsons, and actually Thompsons, and as you well know, rebranded to TUI.
Yeah,
So TUI is the well-known, big, diversified entity, and just a marvelous experience of great people, and ultimately led their events division, which at its peak was probably about 14 different brands, as we try to corral what was within TUI in order to position ourselves offering a broader service and product offering for events.
So just on that deal, how did it come about? Was that you looking for an exit and going out looking for a buyer? Did they approach you?
We weren't actively looking for an exit. I was aware within that broader sports industry, there was a lot of corporate activity beginning to happen, where a number of our competitors were being made offers and were beginning to be consolidated, not by way of brand, but really just putting together a group of different brands. And we'd made contact with them, and so the process started of them getting to know us and us getting to know them, and ultimately it made sense for everybody, and the deal was done. And that was then completed in the April 2008.
Right. So you stayed with them for quite a while afterwards, and you worked your way through their business as well.
Yes, there was no, correct. And ultimately what happened is I stayed on with Sportsworld through 2012 because it was the London Olympics and I wanted to be part of that. So left after that for a brief time when I was then asked to come back and run the events division for TUI, as you've mentioned. So I then stayed with that division through till December 2016.
Right. And then it was at that point, I mean, when did you have the idea about doing the next deal? Was it while you were still in the business?
Yeah, when I was with TUI, there was no question that we were very sports focused. We were building out other offerings, and they just had an absolute gold mine of product and travel experiences and an exceptional organization. But in addition to that, the broader events industry was appealing for me. I hadn't worked in it directly and therefore had an interest in it, and started to recognize that, again, I thought there was some good opportunity for growth. And that's when I started to get to know some of the organizations in that space, had served on an event industry board and got to know a number of people there. So just being in the marketplace, if you will, within the industry, one got to understand who the various players were, which is when I was introduced to Smile, and just an exceptional brand, an exceptional sort of premium positioning within that marketplace, great management team. And I think, if anything, the general principle of the MBOs I think I've done have been with really high quality businesses and high quality management teams, which then just makes the whole process that much more, I suppose, successful and more enjoyable.
Mm. So just to sort of back up a little bit. So you were working in TUI and you had this engagement with all of the other side of the events industry. So did the idea come to you first that you were going to build this integrated events agency and you needed a platform business, or did you start the relationship with Smile first and think, you know, I can take these guys to the next level if I can get them invested?
Yeah, it was the former. I felt that there was a good opportunity to build an integrated event services business, and in the marketplace to find again a platform in a similar way to what Sports World was in the sports hospitality and travel business. And that's how I was then aware, I suppose, of Smile a long time before that, but certainly started various conversations once I'd left to begin to get to know them and what their motivations were and how this might be something that we could bring to reality.
Right. So obviously, I realise there's probably still some corporate sensitivities around the deal because they're still sort of mid-deal, aren't they? But how did that come about then? Did you then go out and try and find private equity for them specifically, or you know, what was the nature of putting that deal together? How did you construct it?
I think it was very similar and a similar process to what I'd argue a lot of people go through. Is the Smile as an organization was identified, worked with. We were together as a management team, and in order to get the transaction done, it was then a question of finding the right funding partner.
Right.
And those are typically a combination of debt and equity, and with similar deals, being able to find the right partner who's got aligned interests, that you know you can kind of work with, not just for the short term of getting a deal done, but obviously long term through the growth of the business to its next stage. All of those are considerations for finding the right partner at the right time for doing the deal. And during the process, there are some partners or some potential partners that fall by the wayside. As you well know, Andy, finding the right partner, and then you ultimately find the right backer, and the organization is going to stay with you.
Right. So quite a lot of work, isn't it, to get one of these deals done?
It takes. I would argue it takes longer than you think. It always takes longer than you think. I would always suggest one starts earlier than you think, and really building a relationship, because ultimately the management of your stakeholders in pulling a deal off is key, whether that be advisors, whether that be funders, whether that be individual management teams at different levels within the organization. You know, getting all of those stakeholder relationships managed takes some doing, particularly when you're the driver together with others in the management team, obviously, to get the deal across the line.
Right. So you served out, I think it was a 2-year chairmanship of the business.
Yes, did my 2 years post transaction, which was just absolutely brilliant experience. And the people there, to be honest, are amazing, together with the positioning of the firm. And then left at the right time after that to then move on to my roots, in a way, back to the kind of sports hospitality space that I'd started off back in Sports World.
Yeah, and I appreciate this is currently sort of a mid-transaction, a deal that you're in the process of building this company. But if you can tell us about that current deal and how that came about.
Yes, absolutely. Then again, I thought there was opportunities to find a good platform business in that space that had been shaken up. The industry had been shaken up. So looking for opportunity for value creation, in a way, where can you actually find businesses with, again, aligned management, so we can build out an organization maybe with a renewed focus or strategic intent, find complementary businesses that we can buy. And we completed that transaction, our first acquisition, in October last year during the coronavirus. So all of that is again going back to a similar principle of identifying a group of management team that you want to work with, secure a transaction that allows you a platform on which to build complementary businesses that either plugs gaps in product, or plugs gaps in service, or plugs gaps in resource man, or actually just gives you some more scale. because through scale, I suspect, in my experience, you're going to get more liquidity, not so much cash, but the liquidity, meaning your ability to buy and sell an investment, how quickly you can get in and out of an investment. And the more liquid that is, the higher the value. And arguably bigger businesses are more liquid to get your investments in and out. And that is a key consideration, I would suspect.
Okay, so you mentioned a couple of times the word platform, and that is a common phrase, isn't it, in private equity, actually, where you go in to find the first business which you use as a platform, and then you bolt other pieces onto it. So, I mean, that's what you're looking for when you are devising your MBOs, is you're looking for a platform business. And what are the necessary sort of qualities of that business? Is it a profitable business? Is it good management team? What is it that you're looking for in that platform?
So let me be the first to say that I have found that route has worked for me. It's not the only route to an MBO. So, finding a platform business has worked for me, and that's why I suppose I've just stuck with that as a methodology or an approach. But it's not the only way, obviously. What I think is one of the requirements is a quality business. So you're not picking up businesses that are in any way in trouble or problematic, or they've got good recognition, reputation, and it's about moving them forward on the growth curve as opposed to kind of trying to turn them around or anything like that. So that's the first thing to say. The quality business. The quality management team is another one where actually you just coming in, supporting arguably an existing management team to add your bit of experience and skill in order to grow the business further. So there might be a platform that's got an existing service offering and an existing management team, and they all want to grow the business, and you coming in to support that growth. Equally, you're coming in to facilitate maybe getting some cash off the table for some of the shareholders. So there is an angle on any of the MBOs where there is the opportunity for existing shareholders to consider whether they want to take some cash off the table or roll some forward, or and other investors to come in and or debt to be provided. So the platform I have always found to be easier to work with. The first year after any deal is arguably the most critical, because you've got to demonstrate your credibility. You've got to be able to deliver on the promises that you've made when you were marketing the business and closing the transaction. So that first year for me has always been a real defining year to just say, yes, we've delivered on our promises, and therefore maintain credibility across all the stakeholders. And I suppose in that first period is focus on cash, and in the second period is focus on EBITDA, because that's where your value is going to come, ultimately. So those are some of the reasons why the platform works for me, because you've got the opportunity of existing cash, existing management, and then you can divvy up roles and responsibilities, which is slightly easier than you might be able to do if you're buying a business that is in a lot of trouble or problematic or got some other issues attached to it. I'm not saying that those don't offer good value or good opportunities, but they are not the kind of deals that I've done.
Yeah, different opportunities. So the promise that you make during that campaign, I presume, then, is to obviously help everybody get, or some of the members get, cash out of the business for themselves, but also you're promising growth in that first year, and then the ability to bolt together more businesses so that you can all exit for a much higher value.
Exactly right, and it's as simple as said than done, obviously, but it is one of the where that's the positioning of a good base, being the platform, to then add to that EBITDA growth and ultimately realize value in the given the timings that people have set out for that investment.
Right, thank you for that. So I was going to ask you sort of a number one piece of advice. So what number one piece of advice would you give to someone, for instance, who is looking to build an agency business through acquisition?
I'd say don't wait. Whether that's my number one bit of advice, but often people talk about it more than do it.
Right.
So I'd argue get on and start doing it, and in the market, looking for opportunities,
Right.
because
So the first thing, really, the important thing is to just get going, get out there, start talking to businesses, see who's interested.
yes, because there's no doubt that if I'd started earlier, for example, back in sports world, and acquired, dare I say, medium-sized businesses sooner, we'd be bigger, and we would have been able to exit at a higher value. So, you got to ask yourself a good question: why am I waiting, and what am I waiting for? Because it takes so long to curate and complete a transaction, that the sooner you start, arguably the more chance and the sooner you'll be able to complete it. So that certainly would be one question that I'd pose.
Uh, okay, yeah. So no, I think that's good advice, and I think some of the reasons why people stall are probably very different from person to person. But one of the parts of this coaching course actually is really to build up a big list, to go and contact and work your way through that list, because obviously it takes 100 probably agencies or businesses to find probably one or two transactions that are actually going to close.
Yeah, I think that's right. The other bit of very key advice that I was given, or stumbled across, which has served me, and I suppose others well, is really understand a seller's motivation. And motivations are absolutely critical to get the deal done. And the way I position it is, what's the motivations and money? So money is always going to be a motivation. So just name it, state it. And so therefore, what are the motivations of the seller and money? So they're going to want an amount of money, and it depends on obviously how much and how they want to get it, etc. So that's almost given. But what are the actual motivations of the seller? And getting under the skin of that, I think, is absolutely critical to getting the deal done. Because if you can pilot a course in that direction, you're going to nail it, because you are absolutely meeting that motivated need. And I think that does get the job done, the transaction closed, more often than not.
And that can be as simple as almost, presenting them with this opportunity, but getting in their mind, isn't it, almost, and getting them to get themselves there. Where are they going to be at the end of, the 3-year earnout? And, what are they looking for? It's not just cash, is it? It's usually something else that comes with it. But
it's always something else that comes with it. And that's my point about motivations and money. And motivations could be anything from time for themselves, profile, different kind of roles, opportunities to spend more time in something else, the ability to write a book. There's all manner of different motivations that sellers are going to have. Sometimes it is as basic as retirement. Sometimes it is, I'm just tired. And sometimes it is because I don't want to go on. I want to stop this chapter of my life and start a new one. I'm going sailing around the world, or whatever it is. But finding what that motivation is for the seller to ultimately sign on the dotted line is critical to getting the deal done.
Yeah, I agree. Okay, so I always talk about a typical deal, in that there's no such thing as a typical deal, but there's kind of a starting point for agency deals, I think, that are fairly common, which usually involves 50% upfront of the consideration and a 3-year earnout. But I appreciate you've worked on a lot of deals, and probably since we worked together as well. So I'd be keen to know if you've seen any types of deals or innovations within those types of offers to businesses.
Oh, definitely.
We work together.
Definitely. And yeah, listen, that might be a rule of thumb, but the reality is it depends on how the two parties agree a deal. So there can be a lot less upfront. It could be that there's a a gradual payment over a longer period, a 5-year period. It could be that there's a scenario where, in fact, if you are buying another agency, that you don't just buy it outright, you actually go down the route of more of a merger. So you do have an obvious party that's the lead, and the merger suggests that actually you've got the earn-out period is slowly the dilution of the merging parties' shareholding. Tax could be a big issue. So, you just want enough day one in order to satisfy the tax liabilities that you're going to have on the deal. So I think people have got a lot more creative in structuring transactions now, and particularly through COVID. So I think the opportunity is definitely there not to follow a prescriptive path and kind of try and work to get a deal done, as opposed to kind of staying with a cookie cutter structure.
Yeah.
And it does depend whether you're a seller or buyer, Andy.
Yeah,
if you're a seller, I would argue you want a lot more than your 50% up front. So it does change in whether you're seller or buyer.
You've got to push for different things, obviously. Yeah. So yeah, I think one of the things I've seen during COVID is much less upfront, actually, sort of 20%, 25% in offers rather than 50% to reduce the risk. And
correct.
Nobody knew when we were going to get back to normal for certain things. So
yeah,
those lower offers at the front.
Yeah, and there's an encouragement to say you don't mind what structure you try. Ultimately you can suggest a structure that's gets a no, and you send packing, and then you try another structure. So just because you get a no once doesn't mean that you've got a no forever.
Yeah, it can sometimes feel like that at the time, doesn't it? Because there's so many fraught emotions involved. So every week we ask our guests about financing deals, because I think this is probably the hardest part for people to imagine at the start of doing an M&A deal or going down this path. It's like, how do we get this finance? But it seems you've gone out looking for a target, and then once you've got the ball rolling, you've found a finance partner to come in with you in using debt or equity.
Yes, and that's right. Yeah, in every case, we've started with a target and taken the view, rightly or wrongly, that the funding will come.
Right. So I was going to ask, if you'd found, so if we were doing this deal now, we found an agency to acquire, what's the next steps to getting financing in place in your mind?
Well, I think if you're close to being able to secure the term sheet with an agency or a company you're buying, you've then got a scenario where running alongside that in parallel, you're beginning to warm up a number of pre-identified potential sources of funding, whether those be high net worth individuals, institutions, private equity, venture, whatever it might be, because you're then at a stage to actually talk about something substantive. There's a very different view when you have a meeting and you're coming with the idea of something, and they would then, as investors, say, yeah, that sounds great, let me know when you're ready, or yes, we can back something like that, send me something when it's finalized. So you can warm people up, but I don't think you're going to get much traction until such time as you've actually got a deal ready to go. That could be slightly different if you're in an agency buying another agency, because you've got your own existing platform position to discuss with an investor, and you're giving them the idea of partnership with you in securing their funding, what you can do with it. And these are the targets that you might have. So slightly different in my case when I'm coming in as an individual versus if you've got your own existing platform to work off, you've got a lot more position with an investor, and they'd start taking it a lot more seriously.
Yeah, excellent advice.
And that's private equity as well as debt, I'd say, Andy, as you well know. The combination of funding, whatever funding structure you need to get the deal done.
Yeah, So quite often, it is kind of a chicken and egg situation, isn't it? You need to kind of know where you're going to go, but at the same time, there's no point in having empty conversations with potential investors. They want to know, they want to get excited by the deal that you've got. So bringing ahead to terms to them, and showing them a deal that's about to close that they can get involved in.
Yeah, exactly right. And remember, they are flat out themselves, and they've got different interests and different deals that they've got to. You've got to, the story behind it, the positioning of it is all absolutely vital to get them engaged, because it's an attractive proposition, and the opportunity that they be buying into supports their own investment strategy and objectives, clearly aligns with yours, supportive management team, demonstrable platform, and the whole thing hangs together, as opposed to you having chinks in your armor depending on what aspect's not quite working.
Right. And again, I suppose there's plenty of frogs to kiss in that scenario, even going out and getting the finance.
Indeed there is.
There's a lot of plates to spin. Not only are you finding something to acquire, but also trying to get the finance in place at the same time.
Yeah, and remember, it's not just about the money. You also want to have people that you can work with and who are aligned with you and have the same buy-in as the management team, because you're obviously going to work with these folk for some time. So you want it to work, not just for the short term, but you want it to work for the long term too, obviously.
Yeah. Okay, brilliant. Okay, so we're nearly at the end already. So can you tell us a little bit about what you're working on next, Chad? I guess you've got a few more deals in you yet.
Well, maybe. I suppose these are all they're aspirational, because I wouldn't be cocky enough to say that I've got a next deal that's going to just close. I think there's a lot of undervalue or value to be explored in the travel sector, if I'm honest. And obviously I've got some previous experience on that, and therefore finding some deals where, again, there's complementary businesses that we can put together in that space, both summer and winter. So I think there's good value to be had in the travel space, because I do believe travel is going to come back and come back well and strongly. And then also in the digital and IT services space, I think there's a number of smaller entities in the industry, and a consolidation is certainly going to happen, and just a question of finding whether within the digital and IT services space there is an opportunity or two. So those are two that are kind of looking at the moment. The travel's quite far advanced, and the other kind of early days.
Right. So, well, you know where to come for digital agencies, don't you? So can you tell us how to stay in touch with you, Chad? I know you're not at all active on LinkedIn, versus most of our guests up to now have been real LinkedIn aficionados. You've probably got one of the
You've got my phone number, Andy. Feel free to call anytime. There's no
old school with you. It's just phone calls.
Yeah, just talk. Let's or emails quite fun as well, and the colleagues that you've got in your group at the moment, happy to take any kind of question afterwards or conversation. Quite happy with my time on that basis.
Brilliant. Okay, well, I will share your email address with them then. So this is where we open it up to everybody who's here. If they have any questions for you while we've been discussing your journey, I'm sure there's been a few things that they wanted to know a little bit more about. So is there anybody that has a question ready to go? Do I need to even ask whether Will's ready?
Hey, Will.
Hi. You might want to finish the video, Andy, and then we can carry on afterwards. I have quite a few.
I'll leave you for a few hours to chat.
Thanks, Chad. That was really useful, and it's been interesting because you come from a very different perspective to the other people that we've had on this. Some of which I don't quite feel I've understood. I think Andy knows your kind of career and the deals that you've done better, and so I'm making some assumptions to a certain extent. But as I understand it, in at least some of these deals that you've done, you've identified, if you like, the target, the company where you want to go in and instill, to execute a management buyout. Where you've gone in and you've sort of said, right, I see the potential here. I'm going to go and raise the investment. We're going to buy out the shareholders and take the company somewhere else. Now, when you've done that, I guess a couple of questions. One is really, in some cases, that how are you pitching yourself in that situation? You know, what do the management team, when they see you arrive and you make your pitch, what do they take you from what you are going to deliver? And then from that, secondly, is then obviously in terms of how that board looks or that shareholding looks, so what kind of level of control, shareholding, or what have you, you're going to seek to take, or what you're going to seek to leverage. How do you pitch that, or how do you resolve those questions?
Yeah, Will, great questions, and they all kind of some of the nitty gritty of the deals. I think, let me just offer up some general principles. I tend to go in to a board position, typically as chairman. The raison d'etre that I would have is that I've worked in bigger businesses, circa 85 million turnover kind of divisions, and therefore the expectation in growth, I kind of have a fairly good feel about what a bigger company looks like and how it runs, and therefore, you know, we can plot that journey of growth for some of the platform businesses to get to that. Organic growth is only going to add a reasonably modest double-digit growth year on year. So acquisitions is another area that I would then support management teams on, to both identify targets, agree terms, get deals done on that basis. So therein lies some of the from a governance and growth. I think those are the two things that I would bring. Governance as to, you know, what do we need to be big, operate as big, and then growth, very specifically identifying, well, where's our strategic differentiation? You know, where are we going to get that competitive advantage, and let's gun for that to get the growth that we're after, supported by these acquisitions that can come in.
So you're a better chairman that they would otherwise previously have had, effectively, aren't you?
Yeah, I'm not making that judgment, better or worse. I'm coming.
But you're thinking bigger, and you're giving them the ambition to do something which they hadn't done so far.
Because I would always believe fervently in what the opportunity was with each of the businesses that I've got involved with. So there's no doubt that I believe to my core in the story, which makes it that much, and I think anybody should really, which makes it more credible and plausible to whoever you're discussing it with, because you genuinely believe in it and the people that you are working with. I'd also be the very first to say it's not about me. You know, there is no doubt that these are existing businesses, great businesses, fantastic reputations, superb products, and excellent management teams. So I'm supporting the efforts as opposed to being the big I am in any of this, if I'm honest.
And back to that shareholder question, because in some ways that shareholding, or that level of control that you're seeking to get, has to align with that proposition you're making to that board in the first place. So how do you do that one?
I've not taken controlling, in some of them I've taken controlling interest, but in the main I would be a shareholder on the register with everybody else, and doing my bit. But the value in that itself for me is sufficient.
And you don't feel as if you need to have controlling share, given that you're coming in as a chairman and you need to be able to enact this. You're always seeking to get that consensus, I guess. Would that be right? Or?
You have to. I don't see, you know, if you've got a big checkbook and you want to buy everybody out and then kind of own it, that's not my style. I'd say far better to kind of work with and alongside people in the trenches, believing in what everybody's trying to achieve, and in doing so, either build consensus, coercion, influence, whatever it might be, to get the job done. Far more carrot than stick in my case. Many, by the way, would disagree.
Well, I mean, it is interesting because it's slightly more, if you like, I don't know whether others may have used the word sort of democratic kind of board, if you like, that you're not driving change, you're coming in to change something, but you're actually doing it from consensus and taking everyone together and not insisting on this kind of casting vote or anything like that. That's interesting. But you've made it work.
But the reality of that is that actually, remember, you're buying into an established organization. You're buying into an established platform that you are arguing your contribution can support to grow further. By the way, just the sheer logistics of it, I don't have the kind of wealth that supports a complete buyout of some of these businesses. So through sheer necessity, I have that position that I've kind of adopt, as opposed to being a controlling either through voting rights or anything else.
Andy, could I go one more?
Yeah, go for it. Come on.
So just
Oh.
trying to kind of understand this as a mechanism a little bit better. So when you see this, you identify this company and the board, and you're seeking to essentially are you buying in to that board and taking some share ownership at that first stage? In which case, are you then getting getting investment to buy your share, or are you subbing that yourself and then taking obviously the group and doing the next stage?
So in each of them has been slightly different, and actually I backed another through one of the entities. I backed another MBO as well, so that gave me another slightly different experience of being owning my own agency that then supported an MBO of another agency, and just seeing that dynamic. So coming back to your question, Will, I would invest myself in the opportunities, and therefore I'm part of the team moving forward, but in my role very specifically as determined, and typically that's been either chief exec or chairman.
Great, thank you.
Pleasure.
I think Will's going to be in touch with you, Chad.
Great. I think it's important to just say, a lot of what I have achieved has been as a result of other people, because in every case it's been as part of a team, and I wouldn't hold myself out in any way, shape or form, notwithstanding the very kind comments that Andy made in the beginning, to be a specialist in this area. But understanding where the value is or could be in a target, and seeing them as the platform on which to build over the next, 3 to 5 years, I think that has been the opportunity that I've managed to do.
Okay. All right. Thanks, Will. And Will's got a very interesting story himself, actually, which I'm sure if you guys speak afterwards, we'll go into.
Yeah, I'd love to hear.
Yeah, he's got a great story. Was there anybody else on that was interested in asking Chad a question while we've got him here? Okay, everybody a bit shy this week.
Well, thank you very much, Andy. It's been a pleasure.
It's it's been a real interesting show today. Really enjoyed it, and good to be in touch with you again, Chad. We've not spoke for a couple of years now, apart from when we caught up the other week. So really good to see you again. Thank you very much for your time. So I'll help everybody connect with you afterwards, so you may have some offline discussions with the guys that are here.
Marvelous. Thank you very much, and all the best to everybody with your endeavors.
Yeah.
Thanks, Chad.
Thank you, Chad.
Take care.
Thanks, Chad. Thanks for your time.
Take care. Bye.
Okay. Cheers, guys.
Cheers.
I hope everybody enjoyed that. The video will be up shortly, and I'll obviously share that with those that didn't make it today. I think we've got a couple missing. All right. So very good, guys. Thank you very much for your input, and we'll catch up in the week, no doubt, and for the same time again next week.
Andy, I might chase him up actually this afternoon if you've got those details for it, just because he's he's on a roll. So
you've warmed him up.
Now is the time. Yeah.
Yeah, exactly. All right, I will do a quick intro on email.
Okay. All right, that'd be appreciated. Thank you very much.
I've got a deal to close at 3:15, so I've got to run it at 3.
It's not a long email. All right. Thanks, Andy. Have a good weekend.
Yeah, good to see everybody.
Cheers.
See you guys.
Later. See ya.
All right. Bye.